What's up guys, Mike here, and today's video is all about the BRRRR method. The BRRRR method is a real estate strategy that you can use to grow your portfolio quickly in a very small amount of time. So real quick guys, just a disclaimer, this is not a get-rich-quick video, so if that's what you're looking for, this isn't for you. As they say, there are a million ways to skin a cat in real estate. There are several methods used to purchase and hold real estate, but I like the BRRRR method because it combines a few creative finance tools that when put together makes investing powerful and attainable for the newbie investor. So before I get into that guys, if you like investing in stocks and crypto, then be sure to check out Webull. It's a great trading platform, especially if you don't like getting locked out of your account when there's a GameStop shortage spree happening. Get your 2 free stocks when you deposit $100. Click the link below in the description. So in this video guys, I'm gonna break down the steps of how to do a BRRRR. I'm gonna share with you the things that you must consider before doing a BRRRR. And lastly, I'll explain the advantages financially to you for doing a BRRRR. So let's get into it. So guys, when you buy a property, fix it up, refinance it, you're borrowing against the value of the property at its highest. If done correctly, this allows you to recapture most, if not all, the money that you put into the property. So as the acronym goes, the BRRRR method is buy, rehab, rent, refinance, repeat. So let's start with step 1, which is the buy. They say you make money, and that's definitely true if you do it right. Most lenders will lend you up to 75% of the property's value. So holders should aim for 75% all in. And if you're prioritizing volume over quality, then you can definitely afford to leave a few bucks in the deal. If that doesn't describe you and you're not doing volume, then I would shoot for 70% for 2 reasons. Number 1, refinancing costs money. Most banks take at least a point plus charge you fees for loan processing fees and refinancing on the back end, which will eat into your profit. Number 2 is aiming for 75% offers you no contingency. On a rehab, people typically tend to go over budget, not under budget. So for building in a bit more of a margin would be helpful to you unless you are doing volume. A number of options can help you purchase your first BRRRR property. Those would typically be cash, private money, hard money, or maybe a HELOC on your existing property. Depending on which financing method you choose is outside the scope of this video, but what is important to note is that different financing options will have different upfront costs. You'll need to account for those costs when analyzing a deal in order to hit that 70 or 75% mark. The key to BRRRR success is buying properties under market value and never investing more than 75% of the property's ARV, which is after repair value. This ensures you never run out of money and you can keep the cycle going forever. So let's talk about your ARV. I recommend having a seasoned real estate agent or a seasoned investor that you may or may not know go over some numbers with you when you start to analyze properties, just to make sure that you don't go over that 70 to 75% mark. You're gonna wanna check the comps in the area of other similar properties that have been rehabbed to make sure that those comps and ARV will support your numbers as you reverse engineer it backwards. So you take that number of the ARV and you multiply it by 0.75. This number is your new target. Your goal is to have the purchase price and the rehab add up to this target number. So that way you ensure your spread is there. If you end up paying too much for a property or you sink way too much money on the rehab for a property, there's very little at that point that you can do to turn things around because the ARV is not gonna change because you overspent or over budgeted. So number 2 guys, the rehab. So there are 2 main questions to keep in mind when doing a rehab on a rental property. Number 1 is, what do I need to do to make this house livable and functional? The second question is what rehab decisions can I make that will add more value to the overall home than the cost to do them? If you rehab correctly and make sure that you add value when you do, you're pretty much guaranteed to recover your money back and then some. So a few things to keep in mind. Unless you're doing luxury rentals, the following items are items you do not need to put in your rentals. This would be things like granite countertops, Brazilian hardwood floors, high-end stainless steel appliances, skylights, bay windows, hot tubs, and chandeliers. Also, another thing to keep in mind, it's very rare that you would want to finish a basement or a garage on a rental. Instead, I would focus on things like fresh paint and laminate wood flooring. And of course, the house needs to be functional and in good shape. Look for homes that you can add good curb appeal that will keep good quality tenants in there. Of course, your new purchase won't be a great purchase when you buy it, and that's the point, guys. I purposely look for properties that need massive repairs, that have way overgrown vegetation, because other investors and retail buyers are going to ignore those properties. And typically the sellers will be more motivated to drop their price on those properties knowing that they have a ton of work that needs to be done. So some of the problems that I look for when I'm looking at a rehab or to buy a property is I'm looking for bad roofs. If you add a new roof to a property, appraisers tend to give you back the money you spent in property value. unfinished kitchens. An outdated kitchen is ugly, but it's still usable. A partially demoed kitchen makes the home ineligible for traditional financing, and therefore much easier to buy with cash and no contingencies. Drywall damage also makes a property ineligible for bank financing, and it scares away a lot of retail home buyers. The good news, drywall is cheap and easy to repair. Overgrown, wild vegetation frightens the competition, but it's actually very cost effective, and go out there and take stuff down and then clean it up. You don't even have to hire professional landscaping to do it. Outdated bathrooms. I routinely remodel bathrooms for $3,000 to $5,000. Most bathrooms aren't very big, so you can control your costs. This also allows your house to compare to much higher priced homes with updated bathrooms. Too few bedrooms. This is my favorite. Homes with more than 1,200 square feet but less than 3 bedrooms are typically what I look for, because it offers an easy way to add value. Adding a 3rd or 4th bedroom to a home helps it compare to bigger homes in the area and raises the ARV. By targeting properties like these and adding repairs to your homes below market value, you can add big equity to your deals right off the bat. So moving on, guys, number 3 is rent. So banks rarely want to refinance a property that isn't occupied. So having a renter in place before you go to refinance is key. Finding good quality tenants is outside the scope of this video, but I will say you want a good diligent screening process to find reliable tenants. When that appraiser from the bank comes out to assess that property and give it an appraisal, make sure that the tenant is friendly to them, because that all matters. We're all human beings, and if they get a bad taste in their mouth or they feel like they're not wanted there, that could affect the appraisal price that bank now gives you. You need to notify your tenant before an appraisal comes. So once you get it scheduled, send them a card, maybe give them a phone call, or swing by the house and post something on their door. I always recommend that you request interior appraisals versus drive-bys. You're not going to get the best foot forward when an appraiser can't view the actual property inside and he's only doing it from the drive-by from the street. That's going to hurt you. It's not going to help. One thing here to keep in mind with the BRRRR strategy, guys, is your mortgage is typically going to be higher than it will on a primary residence because you're borrowing money against the house. This is well worth it though. Capital in the bank is used to grow wealth, while equity that you have in the property really can't be used for much. The flip side of this argument is that your cash flow will be slightly lower with a higher mortgage payment. This just means that you have to be that much more diligent in knowing your rental comps for the area that you're buying in and what you can expect to get once you rent that property out. This just means that you have to be more careful and run your rental comp numbers to know what you could get for rent when you rent that property out. Next is refinance. When you look for a bank to refinance your property out of your hard money or private money loan, here's a few things that you guys need to ask for. Number 1, does that bank offer a cash out refi, or will they only pay off debt? If they won't offer you a cash out, my advice is to move on. Number 2, what seasoning period do they require? Seasoning period is how long you have to own a property before a bank will refinance and lend on the appraised value of how much you've invested. For the BRRRR strategy to work, you must borrow on the appraised value. These days, some banks are willing to lend on the appraised value as soon as the rehab is complete and rent it out. These are the best banks to find. So how do you find these banks? I would ask around, talk to local investors at your local REIA, real estate meetup groups. They'll know who to use. Another way is you could look in the county tax records and see what banks are carrying a lot of loans in a certain area that you know a lot of rehabs are going on in. Typically, then you'll find out who those banks are, and that's who I would start with. When you go to refinance your property, make sure you provide the lender with clear, thorough information. The more concise the information is and the quicker that they can arrive at a valuation, this will make them happy and probably be more in favor of working with you. The trick here is to get as high as an appraisal value as you can. The biggest part of success in this area here is how well you did the rehab and how strong your comps were of the ARV before you started. Sinking a lot of capital into a deal and not being able to pull it out is a major problem. I recommend getting pre-approved by that bank before you even start. The last step is the repeat. Now this is the most fun. Take everything that you've learned, gained, and made mistakes on and improve on it on the next run. Systems help you accomplish your processes more quickly and efficiently by repeating the same steps over and over. Systems are gonna cut down on your mistakes and on your stress. The more documented your systems are, the less you'll have to worry about overlooking or misplacing something. So guys, what to consider before doing a BRRRR? I definitely think doing BRRRR investing gives investors the most bang for their buck, but there still are a few things that you should look for before you dive in. The short-term loan. Now, if you can buy your first BRRRR using your own cash and you want to, that's great. Now you don't have any stresses about using a short-term loan. However, if you do need short-term loan financing such as hard money or private money, there's a couple things you want to consider. What do your carrying costs look like? My best advice here is to ask your lender for a rate and term sheet and understand those terms. Also, what kind of rate can you get? How many points are they going to charge you? One alternative is you can use a HELOC on your existing property if you have equity in your existing home. This gives you initial funds without having the same short-term risks that you would have from hard or private money. Number 2 is appraisal risks. Refinancing is a critical step in doing a successful BRRRR. Otherwise, it would just be a BRRRR. Although refinancing also entails an appraisal to be completed, which makes your math done at the beginning before you even buy that much more important. If you miscalculate your ARV and the property does not appraise, you'll have trouble repeating that deal. Number 3 is waiting for seasoning. This is another annoyance of refinancing. Many traditional and portfolio lenders require there to be a seasoning period of 6 to 12 months. If you're using a private or hard money lender, it's very crucial to calculate exactly how much this time period will cost you with them. Number 4, rehab pains. You might love the idea of renovating houses, but I promise you it's nothing like they make it look on HGTV. There's no time-lapse camera work here. Prepare to juggle absentee and problem contractors, surprise problems like asbestos and other headaches, break-ins to steal copper, your tools, you name it. Rehabbing isn't necessarily bad, but it does require thick skin to get it done. So now let's talk about the advantages of BRRRR. Unlike traditional investing, the BRRRR method is designed to win you deals quickly and to keep your money growing so you can build wealth. Some of the reasons for this is because you're paying less for properties, because you're either buying distressed properties with cash, or at the very least without a financing contingency at all, aka private hard money. You're buying properties that don't qualify for traditional financing. You can close your deals with fewer contingencies, if any, and you can improve the properties through rehab and create forced appreciation, aka equity, so that way you can continue to do the cycle and buy more homes for less money. So let's do a quick example here. Say you pay $70,000 for a house that has an ARV of 100. You put in $10,000 in repairs, and that brings your total all-in cost to $80,000 on a property that's worth $100K. With the BRRRR method, the refinance portion comes after the rehab. The bank bases the property's value on its $100,000 worth, not the $70,000 that you paid for it. At the same time, 75% loan to value, we could refinance and pull out 75% of that $100,000 property. Considering we spent a total of $80,000, $70,000 on the purchase plus $10,000 in rehab, we would be walking away only leaving $5,000 into that deal. If you compare that to the traditional method of purchasing real estate, that's a difference of $22,000. The BRRRR method in this case returned to us $22,500 more than traditional buy and hold investing. That's a huge difference. With BRRRRing, you can potentially get a property and at the end of it pay nothing at all out of pocket. You do this through buying right, rehabbing correctly, renting it, refinancing it, and repeating it. Even with taking into consideration private and hard money loan fees, you can still actually do this. You get a higher return on investment with BRRRRing. You don't need a ton of money out of pocket to pull off a successful BRRRR. The less money you have in the deal means your higher ROI on the back end. Let's imagine, for example, if you invested $10,000 into a property and it cash flows $2,500 a month. That's a 25% cash on cash return. And that's not even including the equity that you have in the property either. Which brings us to building equity. One of the best parts of the BRRRR method, because you're choosing properties that have serious rehab potential, is you're building forced equity. That equity now waterfalls onto the next deal to keep your net worth growing as you acquire more properties. Renting a Class A property. You've put your blood, sweat, and tears into rehabbing this property. Maybe it started as a Class C or even a Class D when you bought it, but now after your rehab, it's now a Class B plus or maybe even an A class. That means you have better tenants and fewer rental expenses. So there you have it, guys. I hope you now have a better understanding of the BRRRR method and how you can use it to build your wealth through real estate investing. If you have any questions or comments, leave them down below. I'll be happy to answer all of them. And if you got some value out of this video, do me a favor and pound that like button, hit that subscribe button, and click the notification bell as I post videos here weekly on this channel. Also, be sure to check out my drumming channel down below. I'll put a link in the description for that. And thank you very much, guys. I'll see you on the next one.